So in this video, we're going to complete a balance sheet and income statement from scratch. We're going to use the 2023 question paper. Now, when we're doing this thing over here, this income statement and balance sheet, we don't need the question paper. We'll only need the journal entries over here, right? Now, when constructing the income statement and balance sheet, although they're two separate questions, I like to do it one time. Because when we're doing the entries and transferring, you'll see it's actually easier. But if you want to do it income statement and balance sheet separately, it's fine, right? So, the first thing which I want to do is take note of the format. So you got your sales, your cost of sales, your gross profit. You just need to, income statement is all income added, all expense added, your plus and minus. That's literally it, right? Balance sheet, same thing, just know the format. Literally assets, and then your equities, and then your liabilities. So basically what we need to do now first, anytime constructing it, right, before we come to the journal entries, you have to take all these amounts, opening balances, and transfer them. Okay? So the first amount is vehicles at cost 600,000. Now, vehicles at cost 600,000, where will it go? Now, remember, I told you I'm doing this all one time, balance sheet, income statement, because you'll see why it's better. Now, what I'm going to do is I'm going to highlight what I already did, so you know, right? So the first thing now, vehicles, here, 600,000, right? This amount, why it's not working? Alright, so this amount of your 600,000 vehicles at cost. First thing I'm going to do, vehicles is a non-current asset. Now they said over here property, plants and equipment. That's the same thing as saying vehicles. So even if you want to do vehicles, you can put that there. Vehicles. And put the amount of the opening balance, which is 600,000. This is done, right? So that amount is done. Okay, I don't know why it's not working, but yeah, that's done, right? Now, the next one, if we're going to look at it, accumulated depreciation on vehicles. Now, accumulated depreciation on vehicles, you will always minus this from the opening balance of the vehicles. So that is why you go over here and you say minus 150,000, right? Because that's your depreciation. The value is going down of your vehicles account. The next one is inventory. Inventory is a current asset. So you go to current assets. Now just know you have to draw all this up. So you have to draw the current assets, the assets, non-current and all, right? So you go to the current assets section. You put inventory down and you put the opening balance at 65,000. Perfect. Stationery on hand. Stationery on hand is a current asset. So it's 10,000. So you go to stationery on hand and you put 10,000. The next one, trade receivables. Trade receivables is a current asset. You go over there, go to trade receivables, put trade receivables down, put 38,500. 38,500. The next one, accrued rental income, 5,500. Now, you will realize that we already did the journal, so we know this thing. We don't need to put it in our financial statement this year. Or we might, but I don't see it. Actually, no, we don't need to. Wait, let me make sure. No, we're going to. Oh no, wait, we're going to, but like we won't do it now, right? Because firstly, remember, this is not an opening balance. Accrued rental income 1st January is not an opening balance for 30th November. So we'll just ignore it for now. When we come to our journal entries, we did a journal entry for that. We're gonna record it then. So, actually, what on earth am I saying? Accrued rental income 5,500 is over here. Okay, so yeah. Yeah, so actually, yeah, those are balances, right? So I guess you put everything that's on here over here. So next thing is bank is 120,000. So bank is a current asset. Now what's the amount? It's 50,000. Perfect. So you put bank down and you put 50,000. The next one, loan. Now we're done with the assets, so we go to loan. So you see how we did literally all the assets we put down. Perfect. So the loan is a liability. It's a non-current liability. See, current and non-current. Under non-current, loan you have is 120,000. The next one is trade payables. That's your current liability. So your current trade payables 45,000. The next one, share capital. Share capital is an equity. So you put your share capital down in 100,000. You'll find that there's no adjustment, so you can put it straight in the total, but you don't know this until you do adjustments, so you can just put it in brackets over there, then put it over there. Retained earnings is an equity. So retained earnings, 211,750, you put 211,750. Sales. Now you're done with the balance sheet, you go into the income statement. Because now all income and expenses go in the income statement, right? All assets, equity and liability go in the balance sheet. So you see why I'm saying do it together, because now we don't have to do this first, balance sheet, then come back to you and do the income statement. Sales. Sales amount is 260,000. So you put sales and in brackets you put 260,000 because we got adjustments after to get this final amount. Cost of rental income. Rental income will go into other income. Rental income, as you can see over here, says 3,250. The next one, cost of sales. Cost of sales is just below sales. Here's a yeah. So you put cost of sales down and the balance, bring it down, 115,000. The next one, wages. Wages is operating expense. So all your wages, as you can see, we already put the balance down, 40,000. Interest expense. Interest expense is the same, falls under operating expense. Most likely interest expense would be just before you do the profit, so just before that. Interest expense, it's 11,000. The next one, telephone expense. Telephone expense, it's an expense, so telephone expense, 15,000. Now this remember, it's in brackets all this, right? Or you can put all positives over here, and then operating expense, you add all these up and then you put a negative figure. Or you can do this, but you must just know income minus expenses. That's your income statement, right? So know that. Yeah, so all this is done. I might be thinking how I got all these over here, but there's no balances. It doesn't need to have a balance. Adjustments, you can make accounts, new accounts, and put it in here, right? You'll see what I'm doing right now. So bring everything down. We did all this, right? So now we did all this done. So what we're going to do now is, these are our adjustments we did, and we're going to transfer these adjustments in our income statement and balance sheet. So the first one, debit bank 30,000. So you go to bank. Now bank we know is in a balance sheet. Bank 30,000. Yeah, so we debit 30,000 means you're increasing bank. So that is why I put 30,000. Credit loan 30,000. Credit a loan. That means you're increasing a loan by 30,000. Go to your non-current liabilities, you'll find your loan, you put plus 30,000. Done. And then debit interest expense. That means you're increasing interest expense, right? Go to your income statement, go to interest expense, plus 14,700. Then credit accrued expense. Now accrued expense is a liability, that is current liability. So accrued expense, now you see we never have an opening balance, but now we put accrued expense over there. And we put it as 14,700. The next one, debit inventory. Inventory is increasing by how much? 30,000. So you go to the inventory, which is under your current assets, and you increase it by 30,000. The next one, credit trade payables. Trade payables is a current liability. You're increasing a current liability by crediting it. That's why you say plus 30,000. So right now you can even put the total because you know you're done. Debit drawings. Now here's the thing. Drawings, normally what you'll do is whatever the drawings figure, in this case 1,000, you'll basically go to retained earnings and say minus 1,000. But here they basically took it out and just put a separate account. But it's the same thing because you're minusing, okay? So that's what you must understand. Your equity is decreasing with drawing because the owner is taking goods in use. So your equity is decreasing. So always put a brackets amount. Don't forget that for drawings, right? But yeah, transfer it there. Credit inventory. Inventory is going down by 11,000. Go to your current assets of inventory. Minus, it's 1,000. Yeah, 1,000. Debit trade receivables. Trade receivables is our current asset. You're increasing it by 1,680. Trade receivables, where is it? Where are you? Here we go, 1,680. Credit sales, crediting an income, that is mean sales are increasing. So your sales, there we go, 1,680. So you see how easy when you do both one time? Very, very good. Debit cost of sales is an expense. You're debiting an expense, this means increasing by 1,200. Credit inventory, inventory is decreasing by 1,200. Inventory is in the current assets, 1,200 minus 1,200. Then debit bank 5,600. Your bank is increasing by 5,600. Perfect. Credit sales. Your sales increasing by 5,600. Perfect. Debit cost of sales. So 4,000 is increasing cost of sales. There we go. Inventory is decreasing by 4,000. So there we go. Let's see. Debit bank. Bank is increasing by 13,000. So let's see. Bank. Where are you? 13,000. There we go. Credit trade receivables. Trade receivables is decreasing by what? 13,000. Then debit bad debts. Now bad debts is an expense. So we put bad debts down because we never have a bad debts, and we put 780. Minus 780 because expense. Debit bad debts, credit allowance for. Now I told you it should be trade receivables, because if you go to trade receivables, check here, they put minus 780. So I think that's supposed to be trade receivables. But allowance for doubtful debts you do say minus trade receivables anyway. So I guess it's the same thing. So debit bank, bank is increasing by 5,500. Where's bank? Current assets, bank. There we go. 5,500. Then you credit your accrued rental income. Accrued rental income is an asset. Accrued rental income, where are you? Accrued. There we go. Minus 5,500 is decreasing, because accrued income is an asset. Credit, decreasing. Then debit accrued rental income. So plus now 6,050. Then you're minusing rent income, credit rent income. Yeah, 6,050. So you go to rental income, your income statement. There we go. Credit rental income. Yeah, income crediting. That means it's increasing. Debit prepaid expenses. Prepaid expenses is a current asset. So let's go prepaid expense. There we go. 1,500. Credit bank. Bank is decreasing by 1,500. Debit PPE furniture. PPE furniture is basically your property plant. So basically all this you can put over your vehicles, your furniture. That is why we say 50,000. Okay. And then bank 50,000. Did we do that? No. Credit bank, yeah, 50,000. Debit stationery expense. So you go to stationery expense, you put there minus 2,000. Stationery on hand is a current asset. Here we go, minus 2,000. Bank charges is an expense. There we go, minus 1,600. Credit bank. Let's see, where's my bank? Where are you? There we go. Last one, minus 1,600. Debit depreciation. Depreciation is an expense. There we go, 150,000. Credit accumulated. Accumulates depreciation. I told you always go and minus it from this account. There we go. And we're done. So right now we did it. There we go. Income statement, balance sheet done. All stuff has been done, right? Station on hand, I did it. Yeah, minus, yeah. Station on hand, this one I did. So as you can see, I did it, right? Done. Now what you need to do is total up. So sales minus cost of sales will give you gross profit. Gross profit plus your income minus will give you your, it'll actually be a negative. So if it's a negative, it'll be loss for a year. If it's positive, it'll be profit for the year. So this in case loss for the year. Total, you get your total assets. Equity and liabilities, total. Oh yeah, I told you. Retained earnings, this minus 18,700. This is drawings, huh? We did it before. I told you drawings, debit drawings. So you'll see minus 18,700. Oh no, wait, debit. Now wait, retained earnings. Yes, I forgot to tell you this, right? So where does 18,700 came from? This minus. So basically your retained earnings, the way it's done, you put your balance at the beginning, which we got from the balance, for the trial balance. Then what we're gonna do is gonna check our profit for the year. So it's a loss of minus 18,700. So we take this minus 18,700 and your retained earnings, you say minus 18,700. You see? So that's your retained earnings. Because retained earnings, you work out what's your actual like profit after drawings and after your thing. So yeah. So yeah, that's basically it, and you add all up, and yeah, that's how you do your balance sheet and income statement.